Nothing's perfect. This is the Issues Watch podcast. Hello and welcome to the Issues Watch podcast. I'm Brad Muniz, your host for the bi-weekly accounting and auditing episodes. I'm an assurance principal at Clifton Larson Allen. Back with me today is Marissa Flood, assurance senior at Clifton Larson Allen. Welcome back, Marissa.
Thanks, it's great to be here.
What happened with Matt?
Drink your water.
Uh-oh. This might be my last episode, I think. This episode qualifies for Nano CPE credit. If you're interested in earning CPE credit for this episode, hit the pause button now and head over to njcpa.org/nano to find out how. A quick disclaimer, the views and statements expressed herein are our own and not necessarily those of NJCPA or CLA. Whew, okay. So, the reason why I said nothing's perfect is because we're going to talk about another post-implementation review. Now, this wasn't an official post-implementation review. The AICPA put out an article, it was in the Journal of Accountancy, that talks about a implementation of SAS 145, the risk assessment guidance, a year after. I think it was one of the most recent magazines, and I get the magazine, I read it while I'm in the middle of the second year of implementing 145.
Yes.
So I would have thought that they would have put that out in like November, December.
But here we are.
But here we are. So I went through a second season of it, and if I did anything wrong the first time, that means I would be doing it wrong again.
Third time's a charm.
Third time's a charm. Okay, I like your optimism here.
Yeah, I try.
Yeah, so it's titled Lessons Learned from the First Year of SAS 145. Now, SAS 145 came out a few years ago. It was effective last tax season, busy season, opportunity season, whatever. And it replaced or kind of supplemented the original risk assessment suite 104 through 111, which came out around 2006 or 7. You remember that, I'm sure.
I was in middle school, but yeah, it sounds fairly familiar.
That's what they talked about in middle school, right?
Yeah.
All the cool
Yes.
kids were talking about it? Yeah.
Yep.
Okay.
Big
Okay.
stuff.
So, I mean, they took 104 through 111, was that eight pronouncements they took to come out with the risk assessment, and then 145 comes out and they try and squish it all together. Now, I've done a lot of peer reviews, and I will tell you, nobody really understood 104 through 111 good. I don't think people understand the 145 either.
No, I've personally had some issues with getting that implemented correctly.
Really?
At least the first time around, it was a tough to wrap our heads around everything and the different SCADA beads and.
Oh boy, we're going to
yeah,
talk about
I
that.
know,
later.
that's your favorite word. So
Oh gosh, SCADA beads. Okay, well, you'll get to that one. Just think about what that is while you're watching this. You can Google SCADA beads, see if that even exists. Okay, good luck. So, some of the significant changes: it requires the auditor to document a separate assessment for inherent risk and control risk, and the reason why that's big. Then people like you who weren't practicing through 104 through 111, 104 through 111 never said you had to document the inherent risk. Mm-hmm. So now 145 finally came out and said you have to do it. And when I used to do a lot of peer reviews, I used to hit the people and say, where's your risk assessment? The smart ones would say, it doesn't really address it. I mean, even the guidance that I read never really used the word inherent risk.
I remember having those conversations in meetings, planning meetings.
Yeah, so when I used to nag people. That's what she's saying. If the auditor does not plan to test states, if the auditor does not plan to test the operating effectiveness controls, then control risk is required to be assessed at the maximum. The reason why I found that interesting is years ago we used to look at notes payable. Right? Where are the controls around notes payable? Can somebody just go out and get a note in the company's name? Common stock, how easy for them to issue common stock. So we're sitting here saying, well, we're not going to test controls, but where's the control risk in that area? Mm-hmm. This says if you're not going to test controls, it has to be set at the maximum.
Yeah, and I like this. I do think it.
You like it?
I think it does make it a lot clearer if you
Okay.
understand it correctly and try to wrap your head around everything going on a job per job basis.
Okay, I accept, because what I guess if I look at it that way, the way you're saying is that let's make it clear, Because otherwise, Brad, you're thinking notes payable and you're thinking common stock, which might sound logical, but then people will start going off in all these different areas.
Yes.
Okay, all right.
That's my take on it.
You've changed my
Maybe a
mind.
hot take.
You've changed my mind. There we go. All right. It revised definition of a relevant assertion. I found this one really, really interesting because we talk about this a lot. This in our office a lot. When we do our risk assessments, you have the relevant assertions, and then down below you have other relevant assertions. Okay, which are generally below high. And people don't understand that. Well, after reading this paragraph, they show people. A revised definition of relevant assertion. It's an assertion is relevant when there is an identified risk of material misstatement. For a risk of material misstatement to exist, there's both a reasonable possibility for the misstatement to occur and a reasonable possibility that the misstatement will be material. That's the big thing, is that, and what I want people to understand is we're supposed to be focusing around risk of material misstatement.
Yep.
And you've gone through a lot of second reviews in our office, and I've done a lot of second reviews. And we've been told that by some people, you have to scope in, you have to include into your assessment certain areas. And I've said, but there's no risk of material misstatement.
Yes. The big why.
Right. Right. I don't have a relevant assertion here. So instead it just goes into other, but okay. Requirements related to the firm's understanding of the design and implementation of the client's system of internal control in the following areas: controls over significant risks, controls over journal entries. That's a big one. A lot of people forget to identify the controls. Controls over where operating effectiveness is being tested. We already talked about that before. General IT controls arising from risk of IT, and then other controls based on judgment. This is big. Well, we don't go into it here. It talks about a lot. You have to now be documenting the key controls. I know that you and Matt are big on discussing key controls
Yes.
versus processes.
We love that.
And I appreciate it because a lot of people don't. I actually saw somebody documenting one time the key control was their audit test.
Yeah, see, and that's again why I do like some of this
Okay.
this standard, because I think controls over journal entries. We talked about this a couple episodes back. Are we harping on certain things a little bit too much? Maybe, opinion my own, but I think it's good. And then the controls over IT, I think we hit on a little bit too much maybe in this standard, but
Right. I mean, first of all, the problem that I see is that we usually have auditors talking to the clients
Yes.
about IT stuff.
and yeah, I'm learning a lot based on that the IT questions we have to ask.
I'm so bad with IT. Jamie over there doesn't want me touching the mic.
I wouldn't either.
The focusing on the risk is a big area. It's the key controls that you should be looking at. And that one where they put the audit procedure as the control, I'm like, I hope that your audit procedures aren't the control here, because now we have independence issues. And now, one of the things to try and pull this all together from the start is you're supposed to determine what's important to look at. And how do you determine what's important to look at? So they come up with it's actually in the guidance somewhere, not in the pronouncement, but if you read different articles and stuff, and they talk about something called SCADA beads. It's one of the words I absolutely hate.
Yes, when you first heard the word, you were running around the office screaming it.
Right.
In fear? I don't know.
When fear is taking over the world. It's gotta be. It's gotta be. Okay, we're accountants, and the coolest words we can come up with are SCADA bead and LIFO and FIFO.
I was going to say, don't forget FIFO.
Yeah, we go out to bars and we say these words, and people are like, what's with them? Meanwhile, lawyers have estoppel, and they have force majeure. No, we've got SCADA beads. Now, I know there are a lot of Trekkies out there, but it sounds like a Trekkie word, okay? And I appreciate people like Trek, but so what does it stand for? SCADA bead, significant class of transactions, account balances, and disclosures. Now, what I see some people do is they look at it as significant class of transactions. then account balances and disclosures. I look at it as significant, anything that's significant that's a class of transaction, a significant account balance, or significant disclosure.
Yes, I would
But
agree.
that would be Scott. So that's the SCOTA beads. When you're assessing what you should be scoping into the audit, and then ultimately doing your risk assessment, you have to look at the SCOTA beads. What's your significant class of transactions, your significant account balances, and your significant disclosures. And from there, you build where your audit risk ultimately is. SCOTA beads.
SCOTA beads.
SCOTA beads. If you see Marissa around, when you go to the convention and you see Marissa at the convention, just walk up to her and start talking about SCOTA beads. She'll love it.
Just yell SCOTA beads. I'll
Just
yell
yell
it back.
SCOTA beads, yeah. Maybe we should get that as part of the convention. People just yelling SCOTA beads. That's it. That's going to be our thing. Shirts, yes, shirts. All right. So we'll get towards wrapping up on this. What I've seen is that people are still struggling with it. They're assessing things in that I don't think that are significant, blah, 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 blah. They're going everything moderate because it makes it easy. I just looked at a job recently where majority of it was low, then moderate, and nothing was high or significant. So I just appreciate if anybody puts thought into it, though.
Yeah, no, I feel like as we kind of tailor everything going forward, hopefully, we go through second round of reviews, third round of reviews, we start to pick up on the things that we need to take out, keep in, kind of be more conformed with it. I think it'll be great, but it takes time.
Takes time. I'd like to see more practitioners thinking about this more, especially as a peer reviewer. I think that we need to focus on this more. I've seen the practice aids that are out there that are commonly used, and I don't think that the practice aids have addressed this enough. It looks just like the old one, and I know how people prepared the old one. So if you have questions, talk with us about it. We love talking about it. Remember, she loves SCOTA beads. Yes. It sounds like a bad cereal, too.
Okay.
All right. In closing, here are some upcoming accounting and auditing events. Frank Boudelet and I will be presenting a 3-hour A&A update on May 9th with a replay on May 16th. Matt Charney and Marissa, hopefully Matt will be around, I don't know. You got rid of him. Matt Charney and Marissa are teaching about best practices for audit walkthroughs at a webinar offered on May 13th and May 20th. And the annual Audits of Employee Benefit Plans conference is on May 19th. Get information on these events and more at njcpa.org/events. And of course, be sure to join the Society's Accounting Auditing Standards Interest Group. Sign up for free at njcpa.org/groups. Thank you for watching or listening.